I'm Greg Hunter. Welcome to USAWatchdog.com. You know, there's been a lot of news about gold, recently, and I've been kind of following this string. You know, we have the Swiss Gold Initiative. We also have, one of the big banks overseas, UBS, settling charges for manipulating gold. And so I've had a lot of folks on to talk about gold, but none better than James Turk. He is the co-author of this book with his friend, John Rubino, The Money Bubble, and gold plays big into this. James Turk, thank you for joining us today. You are an expert in gold, and we have lots to talk about. Thanks for joining us from the UK.
Thanks, Greg. It's always great to be with you.
Well, first I want to talk about, the UBS, Union Bank of Switzerland, settling gold charges, gold manipulation charges. Of course, there's never just one cockroach.
Right.
And, for years, I remember when I first came on in 2009, you mentioned gold manipulation. Oh, no. Oh, good tinfoil hat. You crazy cuckoo time. No, even up just a few years ago. Oh, come on. No, there's no manipulation. They're settling charges for what else? Manipulating gold. Other banks are to follow. Well, how does that affect what's happening here in the gold world with this big beat down in gold? Is it going to stop getting beat down? Is this going to affect it on the way back up to reprice in some normal fashion?
Yeah, the UBS thing was, expected. Eventually it had to happen because, when you lift up the rock, all of the bugs will go squirming away. And, it was inevitable, and it should silence a lot of the doubters who had said that the gold market is not manipulated. But anybody who's experienced with gold and watches the way it trades day to day knows that it's been manipulated. It's continuing to be manipulated. The fact that we're in a very deep backwardation at the moment, in other words, the spot price is higher than the future price, shows that gold is being manipulated. The price is too low. There's not enough physical metal at the moment, which is causing the backwardation. And eventually, some more banks are going to get their hands slapped. But that's the sad thing. They're only getting their hands slapped. The damage that they're doing to the market is almost irreparable.
There ought to be criminal fraud charges for all this stuff. LIBOR, securities fraud, gold rigging, where they got more charges on the banks for FX, Forex rigging. I mean, it's just we don't have any markets. We have a big bunch of manipulation and rigging and fraud and cheaters.
Yeah, I remember in the savings and loan collapse back in the late 1980s, early 1990s, a lot of executives committed fraud and those guys went to jail. It hasn't happened this time around. It just goes to show the influence and the power that Wall Street has over the politicians and over the regulators who are supposed to be keeping the street clean. But it's the banks ultimately call the shots, not the politicians or the regulators.
Well, we have silver in the 15s and gold in the mid 1100s, these are below mining costs, at least for silver, way below mining costs. I hear it's in the low 20s to pull up an ounce of silver, and for gold, I mean, at least on the periphery, we're talking about a lot of mining companies can't make money at 11, 50, 60, 70 an ounce. They can't make it. They can't make it. There's a Russian company that's a mining company, gold mining company, that is teetering on bankruptcy.
Yeah, that's a sign that, gold is unbelievably cheap. We've seen it down at or below the cost of production in the past. And when that happens, that's usually a good sign that, gold has reached a bottom. I'm not necessarily saying it occurred last week, but there's a good probability that maybe last week is the low. What I'd like to see here now in the short term is to form what's called a V bottom. It looks like a V. And if we can get gold back above initially 1180, but hopefully, up toward the 1200, 1240 area before the end of the year, then a V bottom will be in place. And I think the odds improve that we've finally seen the low of this correction that began 3 years ago.
What about this vote for Swiss gold that's coming up at the end of this month? Now, you're on the other side of the pond in the UK, and the reporting over here is there's no reporting about it. This is a big deal. This is a big monetary country, Switzerland, gold, and they're voting to back their currency with 20% gold. They can never sell gold again. Some people on one side of the spectrum say, they'll find a way to cheat. Other people on the other side of the spectrum say, it's doomsday. It's terrible, and other countries that are follow. Where do you fall with the vote if it goes through, a yes vote for 20% gold backing in Switzerland?
Yeah, gold wins either way in this scenario is the way I see it. If it goes through, the Swiss National Bank is going to be buying more physical gold. Other central banks that are outside the U.S. orbit are buying physical gold anyway because they recognize that the problems that we have with currencies today, and they want to, rely on gold's 5,000-year history of money of doing what it does best, preserving purchasing power over long periods of time. But even if they vote no, gold still wins, because that means the Swiss National Bank, instead of following the sound monetary policies that followed, for centuries up until, maybe early 1990s when they joined the IMF, that gold still wins, because it basically means the Swiss National Bank is going to be destroying the purchasing power of the Swiss franc, because it's tied to the euro. And we all know what the ECB is doing. They're talking about putting out another 1 trillion of liquidity in trying to jumpstart the European economy. And all that does is it destroys the purchasing power of currencies. It erodes the purchasing power of currencies. So to me, the Swiss initiative is a win-win situation for gold. And at the very least, it's increasing gold's visibility, which I think is very important.
What about these Chinese yuan facilities, going around the world? Nobody's reporting on it. New York Times, Washington Post, LA Times, ABC, NBC, CBS, and we are being encircled with yuan swap facilities. They're in the UK, they're in Canada, they're in India, they're all over Southeast Asia.
Yeah.
Well, no reporting here. Is that the same over there? Are the powers that be keeping a lid on that?
Well, over here, we're getting a lot of coverage on all of the bilateral deals that China is doing with different countries around the world. And I think this is really quite significant in terms of what China is doing. In September of 2015, September next year, the IMF is going to recalibrate the special drawing right, which is this paper currency it's created. The Chinese yuan is not included in that. And for the past several years, China has been doing everything possible to get the Chinese yuan included in the SDR. If for some reason it's not included in the SDR, I think China's going to go its own way and create its own international currency and start using the yuan and other countries' currencies for international trade, completely bypassing the dollar. So in my view, the writing is on the wall for the dollar. And unfortunately, the Federal Reserve and politicians in Washington really aren't doing anything to try to preserve the purchasing power of the dollar. The federal deficits are still horrific. And the Federal Reserve, even though they said they stopped QE, its balance sheet is still continuing to inch up. And that means that the dollar is being debased. So to me, the writing is on the wall for the dollar, and the Chinese are positioning themselves properly, to be a major player in international finance. They already are, but they're going to become even bigger. And September 2015 is a period of time we should watch to see what happens with the SDR.
Why is the dollar increasing in value right now? A lot of people are kind of perplexed about that. I guess part of the takedown in gold is the strong dollar. It's the teeter-totter, gold, dollar, gold. But why is the dollar so strong?
That's really a good question. And it really all comes down to sentiment. Because if you look at the facts of the matter, the opposite is occurring, what should occur. The Federal Reserve is expanding its balance sheet, yet the dollar is strong. Over the past year and a half, the European Central Bank has contracted its balance sheet, but the euro is weak. So, people are basically following emotion rather than logic or looking at the facts. But on the other hand, they look at Draghi, and Draghi's saying he's going to increase €1 trillion worth of liquidity. So they take that guidance, if you want to call it that, from Draghi at heart, and they look for other alternatives. And the other alternative is basically the dollar. So it's not that the dollar is strong, it's that the euro is weak, the British pound is weak, and particularly the Japanese yen is weak because they're pursuing this crazy program of monetary easing that is, in my mind, on the verge of the cliff, about ready to send, Japan off into Never Never Land.
Could Japan pull? I asked one of my last guests on about this. Could Japan pull the whole world down? Could we sail into 2015 uninterrupted and everything being cool, or could we have some type of big dislocation event that kicks off this spiral in 2015? Could there be a non-delivery of gold and silver? Could Japan, could Japan blow up? Could the U.S. stock market blow up?
Yeah, if it is a trigger, it's going to be in the Japanese banking system and the interlinking of the Japanese banking system to banks in Europe and banks in the United States. That's the vulnerability. And, if the Japanese currency continues to weaken, a lot of the derivative trades that are out there are going to be putting pressure on the various players. If the banks are on the wrong side, That's typically what leads to a banking crisis. And this time around, it's going to be worse than 2008.
Explain why worse and how worse.
Because you have so much more debt, you have so much more interlinking between global economies, and most importantly, you have so many more derivatives today than you did back in 2008. If one of those derivative players goes out, you've got Lehman Brothers all over again, but this time it's likely to be worse.
When you say Lehman Brothers all over, is it just one Lehman Brothers out there, just one cockroach out there?
Well, what happened last time is they sort of, put a thumb in the dam before the dam broke. Lehman Brothers was the only one that they really let go under. Bear Stearns went under as well, but that was slightly different. But the Lehman Brothers one was critically important because it had all of these derivative obligations. And when it could not fulfill its derivative obligations, all of these other players, like Goldman Sachs and the big banks, were all vulnerable to, losing a large amount of money and basically taking a big hit to their capital base. It's a daisy chain of IOUs. And this daisy chain of IOUs is always, if you look back at monetary history, these credit bubbles always fall apart eventually. And when they do, it's not very pretty.
What does that look like to the guys on the street? And I have people in the UK that are very worried. I have people write me all the time that are very worried, that say they don't really get the full story over there as to how bad it is, and they are doing things like buying gold and storing food right there in the UK. You think I was getting an email from somebody from Middle Michigan or something, but how bad could this get for the man on the street if this daisy chain of default happens and it's worse than 2008? Yeah,
it could get bad, but it gets to the point, Greg, that what we have to do to protect ourselves when you're in a crisis and when you see a credit bubble popping. And it comes down to basics. There are two kinds of wealth. There's tangible wealth, things like farmland, things like houses, things like timberland. And then there's financial wealth, all of the IOUs and promises that are based on somebody's capacity to fulfill that promise. And when you're in a credit crisis, and when you have too much debt as we do today, you want to be moving out of any kind of IOUs. You don't want to hold those in your portfolio. You want to own tangible assets. I'm talking about tangible assets of all sorts, not just gold and silver, but other things like I mentioned, like farmland. Or you want to hold equities of what I call a near tangible asset. In other words, the stock market has two types of basic types of equities. You have financial companies, and those are involved in the IOU sector of the economy. And then you have the tangible companies like an Exxon, which is involved in the tangible asset of the economy. I would focus on the equities that are involved in the tangible side of the economy, commodity producers and things of that nature, as a way of protecting your wealth. But stay away from the financial side, the banks, the credit card companies, and all of those types of things, because they're all based, insurance companies, they're all based on IOUs. And if you look at what's happened in the past when you have a credit crisis, it's the IOUs that disappear, and that wealth gets destroyed. But the farmland is still there at the end of the day.
Why is oil going down? Is there really a glut of oil on the world stage, or is the economy so weak behind under the scenes that just people are just using less of it? We're told, we have a booming economy, and gas revenue, gas distillates, inventories and gasoline and oil is rising in terms of inventory, and there's plenty of oil out there.
Yeah.
Is that part of the reason why, or is it just because the dollar's so strong that oil's down?
Yeah, that's part of it. Oil is not down as much in British pound terms or Russian ruble terms as it is in dollar terms, because the dollar is relatively strong compared to the other currencies. But there are a couple of reasons for it. You hit a good one. If you look at gasoline consumption in the United States, it's been going down since 2008. That's not the sign of a good economy. Electricity consumption has been going down. That's not the sign of a good economy either. And it's the same thing over here. The economy is very weak, so you generally have a fairly low demand factor. There's also the geopolitical issue. Some people say that in order to put Russia in a more difficult position, the U.S. has encouraged some of OPEC's producers to oversupply the market, so that Russia, which is generally based resource economy, doesn't earn the foreign exchange that otherwise would earn if crude oil were, over $100 a barrel. So, just like gold and silver are cheap, crude oil looks pretty cheap to me here too, even with the prospects for weak economies around the world.
What about Obama overseas? I know you don't really comment politically, but, I'm asking you about this because, weak president could mean weak currency. Right now the dollar is strong, but boy, the president sure looks weak. I mean, Chinese newspapers creamed him over in Asia and, called him a lame duck. Completely just, to the president of the United States. Nobody really came to his defense, at least here in the U.S., the Wall Street Journal, New York Times. People like that aren't rushing to, hey, we can't say that about our president. Everybody's just kind of zip it. What does that do to our currency? What does that do to our standing in the world?
Yeah, well, he is a lame duck president. Everybody knows that. He's badly wounded because of the way the elections just went a couple weeks ago. But consider this. Just before the trip to China, Canada, one of our closest allies and our neighbor to the north, announces a bilateral trade arrangement with China to deal in Chinese yuan and Canadian dollars, bypassing the U.S. dollar. So, the outlook for the U.S. dollar is not good, despite this temporary strength that we're seeing. It's not good, and to me, the writing is on the wall for the dollar.
When are they going to pull the plug on this? Are they going to just one day wake up after 2015 and say, hey, we're going to reevaluate the dollar? Or is it we're going to have some kind of a dislocation, or we're going to have some kind of a big dollar panic sell-off? That's what John Williams thinks, that we'll have a dollar panic sell-off at some point. More than 16 trillion liquid U.S. dollar assets, according to him, at least easily, are held outside the U.S., and he thinks there could be a stampede with that kind of trillions of dollars, a stampede out of the dollar. You don't need it all sold. A couple of trillion would do the trick.
Yeah, that's exactly right. What the U.S. government will do, though, is do everything in its power to protect the dollar's position, and that means more capital controls. There already are capital controls in place. It's almost impossible for a U.S. citizen to come over here to Europe and open a bank account. They just don't want to deal with U.S. citizens anymore. A next type of capital control would be that 16 trillion that's outside the United States cannot come back and be spent in the United States. If that were to happen, all of those dollars overseas would fall to a huge discount to the domestic dollar because they don't have the same usefulness if they can't be spent in the United States on goods and services.
So hold on. I want to interrupt you here. Isn't that kind of a default? Hey, you bought these bonds and you bought these, dollar-denominated bonds. Yeah, you can't cash them here. Well, isn't that a default? Wouldn't that crush the domestic dollar as well?
No, it won't crush the domestic dollar. It will crush the international dollar relative to the domestic dollar. The domestic dollar, though, will be inflated away in any case over the longer run. But the immediate impact will be on dollars outside the United States. And, of course, it is a default. But the U.S. has defaulted before. It defaulted in 1933 when it refused to pay gold on its gold obligations. It defaulted in 1965 when it refused to pay silver on its silver obligations. And it's defaulting every day when it diminishes the purchasing power of the dollar, because what a government is supposed to do is to maintain stability and purchasing power of the dollar. And today, a dollar purchases like 1 penny of what a dollar in 1913 purchased. That's how bad the inflation has been. And that big picture thinking is sort of important because, we've had inflation and debasement of the dollar for 100 years. And people say, well, it's been 100 years. Why couldn't it go another 100 years? Well, if you look at the Roman Empire, for example, it debased the denarius for 100 years until the denarius eventually fell off the end of the table. So you have to assume, just because that trend's been in place, that it's not going to continue forever. And the key here is the amount of debt that we have in the system and the amount of money that the politicians are spending. The only reason why we haven't had that hyperinflationary spiral that I've been thinking about, that John Williams and others have been thinking about, is simply because the U.S. government has managed to keep its debt lower than it otherwise would be because the interest rates are zero. If the U.S. government was paying a normal interest rate on its debt, let's say 6 or 7%, $17 trillion, you're talking about 8%. Every 1% would be 8% more on what the U.S. government is spending, which means that they would be borrowing more money in order to meet this deficit, just to pay interest. And that's how you ultimately get into an inflationary or hyperinflationary blow-off. So we're walking on a tightrope here, Greg, and it could go either way, but to me, it looks like more currency debasement, probably tighter capital controls as the U.S. government circles the wagons to try to maintain this privileged position that it's had for decades that is no longer deserved because they're destroying the purchasing power of the dollar.
How long can it go on? When does it finally go away? And is it a smooth, slow burn into extinction, or do we have some big dislocation? Could we have a non-delivery in gold, for example, before the end of the year? One of my guests, Harvey Organ, said, "Hey, they're running out of silver, they're running out of gold. We're going to get a non-delivery, a force majeure, a default, a paper payout, whatever you'd like to call it. We're going to get that before the end of the year. What say you?"
Yeah. If the default occurs, and it's going to be over here in Europe between the big bullion banks, that's where the activity takes place. The COMEX is really just a paper market. It's a sideline. Nobody really expects to take delivery of large amounts of physical metal in the United States because after Roosevelt confiscated physical metal in 1933, the whole physical market business moved overseas and it stayed overseas. So, the COMEX is a sideshow. It's just a paper market. To me, it's what's happening here in London, and you're seeing this huge backwardation. If you want to put a big order in, I'm talking $50 million for physical metal, you can't get that metal tomorrow. You're going to have to wait for a while before you can get that metal. And that's a sign to me that, gold is cheap. Same thing's happening in silver. And as a consequence, you're going to see much higher prices, my expectation, as we move toward the end of the year. But as for predicting, when that event will occur, we've seen the slow burn in the dollar, and it will continue a slow burn for a time being. You have these blips up and down, that you're having a momentary blip of dollar strength. But eventually it's going to go over the edge of the cliff because that's ultimately what happens when a currency collapses. Eventually people understand that the currency no longer makes sense. And the fact that you're not earning interest on that currency, the fact that you have the risk of bail-ins and all of the other problems, ultimately people are saying, I don't want to put my money in the bank. I'd rather buy Exxon. I'd rather buy a railroad company. I'd rather buy, a commodity producer. I'd rather buy gold or silver or anything else.
What I wanted to bring up, one last thing, is I wanted to talk about the Islamic State
Yeah.
wanting to use gold and silver coins. Now, I think they're evil, brutal, crazy. They crucify Christians. They cut the heads off of people, including Muslims. They have done all kinds of atrocious things. And some people say they were funded in part by the U.S. and our allies, Saudi Arabia and other people. But one of the things they are coming out with that I say, not so crazy. They want to back a new dinar with gold and silver. Is that any kind of a marker, a red flag? Does that make any difference, or is that just really just all talk and not a big deal?
Well, I saw that, and I really wasn't too surprised by it because, most people don't understand that until 1968, there was no such thing as paper currency in Saudi Arabia and most of the Gulf states. They were using gold and silver coins because gold and silver coins is part of what's called Sharia law, which is one of the fundamental principles of Islam. You can't use, there are lots of restrictions on debt and interest and things like that. There's also restrictions on the type of money that you use, and the money has to be a tangible asset. And that's why until 1968, the only thing you could use, even on big business deals, I had a family friend who had a concession in Saudi Arabia. When he bought that concession in the late 1950s, he paid for it with a chest of Maria Theresa silver thalers. That's the way they did business up until 1968. So it's not too surprising that they were bringing back this basic principle of Islamic law. But yeah, you're right. It's sort of weird that these guys are so crazy in so many other respects that they're actually concerned about going back to Islamic law in terms of the monetary system.
They want sound money. They also want sound executions and sound murders and sound crucifixions, I guess, too. But they also want sound money.
Yeah, it's really quite tragic what's actually happening in the Middle East. It's such a mess, and I really feel, it's just, to see the suffering that's going on there is just horrific. But hopefully it will be sorted out.
What's your rule of thumb forecast for the rest of the year and 2015, just in closing?
Well, for the rest of the year, I think you're going to probably start seeing some reversals of these movements that we've had this year. Meaning, I think gold and silver are likely to move higher. Commodities in general are likely to move higher. I think that the dollar strength that we're seeing, is unsustainable, and that's probably going to start reversing. But what I'm really focusing on, in 2015 is this SDR and the IMF meeting in September, next year. I think that's going to be critical. And as we move toward it, look for some big surprises, some big announcements from China as to how much gold they really have, and also finally lifting their foreign exchange controls. Because in order to be counted in the SDR, and I think that's what China is aiming to do, you can't have foreign exchange controls. So I expect those to be lifted in China next year. And I also expect them to be announcing how much gold they have. And I would not be surprised if they announce that they have something between 3,500 and 4,000 tons of metal in the People's Bank of China.
And one more thing, as one more addendum here, but so if their currency gets included in the strategic or special, special drawing rights? Is that
special drawing rights.
Special drawing rights. I always want to say strategic. It's not. Special drawing rights currency, SCR. Doesn't that mean other currencies have to kind of buoy downward? It doesn't raise the other currency. Other currencies have to kind of, form equilibrium with the Chinese currency. Isn't that correct?
Yeah.
Would that be a hit on the dollar, and wouldn't that happen before the September 15, 2015 meeting?
Yeah, it probably will. I think you're going to see this as we approach that September 2015. It's a question that they say markets, you buy the rumor and you sell the news. So it's all probably going to happen over the first 9 months of next year, and then it'll be a fait accompli announced in September as to what's going to happen. But you're basically right. If the Chinese yuan is included, that means some of the other currencies that are in there, the US dollar, of course, the euro, the British pound, they're going to have to sort of step aside a little bit in terms of making room. In other words, they're going to be edged out. The Chinese yuan is going to become more important. And I think that's a trend that's been in place for a few years and is going to continue for the foreseeable future.
And that means the dollar will be finally knocked off its fine white charger.
Yeah, I think that basically, if you look at the fundamentals of the dollar, they're very weak. It's been losing purchasing power for a long period of time. It's going to continue to lose purchasing power. The question is, will it accelerate in the first 9 months of 2015? I think the answer is the dollar's decline will accelerate in the first 9 months of 2015. It's going to start losing purchasing power at a more rapid rate.
James Turk, he's the co-author of this book, The Money Bubble, also the founder of goldmoney.com. James Turk, thank you so much for joining us today from the UK.
Thanks, Greg.